Hey guys, welcome back to the channel McNallie Money, the official home of power analysis. In today's episode, Anthony Power and I are joined by none other than Matthew Sigel. He's the head of digital assets research at Van Eck. We're really looking forward to this Main Street versus Wall Street discussion and picking Matt's brain on top AI infrastructure trends he's seeing currently. Before we get into it, take a second, smash the like button, guys. Big help to myself and the channel. If you're not already subscribed, McNallie Money, feel free to join and let us know in the comments section below what you thought of today's discussion and Matt's insights. With that being said, let's get into today's interview. All right, guys, away we go. An exciting interview in store for you today. Taking a look at Wall Street versus Main Street, so to speak. We've got Matt Sigel, head of digital asset research, none other than Van Eck, so a major player in the space. You've also got a huge following on X, very active in the community. So we're looking forward to picking your brain here, Matt. Welcome to the program.
Hey, Bryce. Hey, Anthony.
Hey, now good to see you again. We've been on a few panels. We've run into each other in a few conferences. This is your first time on the podcast. Can you give us a quick introduction in terms of what led you to this point in your career?
Sure. I started as a journalist covering finance at Bloomberg and CNBC, more than 2 decades ago. And I think I was relatively early to understand the concept of fake news, that the editors and reporters at these places are strapped for time and they've got other pressures and they're just not always covering the right stories or covering them truthfully. And I got pretty disillusioned with the media business and looked for a way to really actually uncover the truth. Investing is kind of the purest distillation of that. I was fortunate enough to start my CFA, so practicing to learn how to do security analysis, and then I met Kathy Wood and worked for her for 4 years before she started the ARC. So this is in the Alliance Bernstein days, covering tech. Bitcoin didn't exist yet, but we were primed for kind of open source as a market share gainer. We had a bunch of investments in open source technologies, and I had left her and was working on the sell side at a Hong Kong-based brokerage and kind of discovered Bitcoin and got some conviction that it was the first application of these new developments in cryptography, and that Bitcoin and blockchains had the potential to take market share and margin dollars away from some of the kind of centralized intermediaries. So I've been in crypto Bitcoin for 5 years now at Van Eck. We started with zero in crypto AUM. We've got $4 billion now across Bitcoin ETFs and a number of active products in venture, hedge funds, and the ETF that I manage.
Awesome. We'll come on to some of those in a while. You talked about starting as a journalist and then now moving into where you are now as CFA. How did that background in journalism really sort of like help you to spring into your current position?
First was just the incentive. I was constantly interviewing people with more zeros next to their personal balance sheet. And, I was envious and I thought, hey, maybe I can do this. And so I did what journalists have been doing since the beginning, which is network and invite people to lunch and use the corporate card to try to build relationships, and met a few people who put me in touch with the right people. And Kathy, at the time and now as well, she doesn't really hire finance people. She hires people who she thinks can chase down a good story, channel check the truth, confront management, build relationships, and generate conviction. And a good journalist used to do all that. Now maybe there's few and far between. And the sell side shop I worked for, CLSA, actually, that was also founded by journalists. So there's some history of folks making this transition.
That's great. Yeah, we really like how you handle yourself, I guess, on X. Very provocative tweets. You definitely aren't scared to go after management. We want to get into some of the details there. But before we do, can we just set the stage at a macro level? You've got the HODL hat on. Bitcoin's pulled back quite a bit here. What is your macro view on the Bitcoin sector and the AI infrastructure sector currently?
Yeah, so for Bitcoin generally, we've been respecting the cycle. So after the election, Bitcoin and especially alts had that huge move in November, December of 2024, and kind of at the firm level, we looked at some of those moves and kind of scratched our head that yeah, there was a relief rally, but where's the mass adoption? And we weren't seeing that in the alt side. So we for the most part, exited our alts positions in our active strategies at the end of 2024 and really spent 2025 hunting in equities. And it seemed to us that the first order impact of the new regulatory environment was, a lack of enforcement. So the enforcement regime went away, and that kind of put a lot of tokens on equal playing fields that maybe shouldn't have been, and it made it really hard to differentiate the scams from everything else. And we got conviction that public companies were going to build their own solutions in the space and capture a lot of the economics. And institutional investors like the reporting cadence of public companies. We know every quarter what the things to look out for are, the disclosures around who owns what. It's all very standardized. That stuff just doesn't exist in alts. So for alts specifically, we were pretty bearish. For Bitcoin, we didn't sell like we did for alts, but we respect the cycle, and I haven't been adding to Bitcoin as aggressively as I would have been if it weren't this year of the cycle. So I'm just kind of be patient and maybe acquire on a time-based cadence, not so much trying to pick every dip. I still think in a year there's a good chance we can be back at all-time highs. And once the market properly discounts the impact of this election, which may change some of the kind of pro-growth orientation of the regulators, that'll probably be a good time to get back into Bitcoin. Our fund has been focused in these pivoting Bitcoin miners just because there's an earnings growth story, which is very unique in the markets, right? They're growing by orders of magnitude. And then on the valuation side, when you comp these names against the data center peers, a lot of whom don't have the same energy pipelines, they still look very cheap on kind of out year earnings, 2028, 2029. So you get earnings growth, you get cheap valuations. SpaceX IPO is going to help. We can get into that. So we've haven't changed much here in the last few months. Still kind of riding the miners.
Yeah, that's good to hear. I mean, going back to the Bitcoin cycle itself, I mean, you think about the last couple of years with the ETFs, of which your ETF is one of those that were initially approved in that January of 2024, and that the influx of funds into those ETFs, the fact that we've now got so many corporate entities buying Bitcoin on the balance sheet. We get all this data quite regularly through a number of people posting on social media. So we know these balances are going up. And it was interesting to hear you saying that, retail just hasn't filled that sort of like that gap. Do you still think then we are in this 4-year cycle? And I think the difficulty is having been to a couple of the last, I think the Bitcoin industry conferences in New York, where your boss has been a speaker, and your previous boss was Kathy Wood was also a speaker there, giving their targets in the sort of like, I think $180,000, $250,000 range. And is it? I mean, do people really know where it's going, or are they just sort of like estimating from, maybe that from what's happened previously, there's an indication it could go higher? Because we do hear some really bullish numbers on Bitcoin, but it sort of like tends to disappoint more than people appreciate the possibility.
Yeah, I mean, look, nobody really knows. There's no earnings reports. There's no buyer of last resort, right? So all we can do is, look at the past and try to compare and contrast. And the cycle won't exactly match. If it did, we'd bottom in October. Maybe that happens again. I've been looking at it on a volatility adjusted basis. So the last cycle, Bitcoin's peak to trough decline was about 80%. And at the time, BTC was roughly an 80 vol asset. So in any given year, you can expect it to move about 80%. Now the volatility is down by half, roughly a 40 vol asset, and the peak to trough decline was somewhere in that kind of 40 to 45%. So volatility adjusted, you could make the case that 60K, could be a bottom, and the 200-week moving average also right at 60K. We bounced right off it. So, it's not a bad time to take a stab. I definitely bought some things over the last couple weeks, but I'm not like pushing all in. I'd rather do it on this kind of time cadence and make sure that I have a full position by the end of the year.
It's great to hear. That's kind of the approach we're taking. So it's good to see we're on the right track there, Matt. Now, you mentioned the miners transitioning. Obviously, we cover a lot of the AI infrastructure, the power portfolios, but in terms of the core business, the Bitcoin mining, North American pubcos make up a large percentage of the global hash rate. Do you have any concerns as this starts to roll off in terms of network security, blockchain security, and what's your outlook on the pubco actual Bitcoin mining business?
Yeah, I think one thing that's different this cycle is the decline in the hash rate. So we saw that big drop off around the time of the winter storms in February. And then the poor Bitcoin price action probably compounded that hash rate decline. And it hasn't really bounced back like you would expect. And to your point, it's these North American public miners that on the margin are not reinvesting in their businesses. That should lead to better margins for those who remain on the network. Our thesis is that sovereign miners would pick up the slack, and they're doing that to some extent in Ethiopia and Kenya and some other countries, but it hasn't been big enough to move the needle. And I think it's a risk, right? It's like one of those things that people are going to worry about. And we have to make sure that pension allocators and sovereign wealth funds and endowments continue to pick up the slack and buy via ETFs. But I do think the mining issue, the melting ice cube and the fact that the revenues go down by 50%, and now these miners have something better to do with their power. It's a wall of worry for sure.
Yeah, we've seen a couple of the CEOs. Tyler Page came out on CNBC, I think maybe last week or the week before, and said they won't be doing any mining within the next 12 months. That'll all go, and they'll focus really all their power towards HPC. One of the OGs in the space, Ben Gagnon from Keel, has basically said a year ago, came out and said on the podcast, mining's over for his company. The metrics just didn't stack up. But I suppose there's an argument, there are some that look like they're going to stay in the space, maybe the BitDeer, Mara, maybe CleanSpark. These have got sizable hash rates at the moment in terms of, all over 50 exahash, which is significant percentage. And you're quite right. We haven't seen that pullback upwards of the global hash rate. I mean, BitDeer at the moment probably got close to 10% of the global hash rate. If the Bitcoin price is to sort of get to levels next year, potentially could that sort of help them? Or do you think by the next halving, we'll see probably literally all the miners pulling all their power towards this new source of revenues in terms of HPC AI?
Yeah, I think BitDeer and Mara are the two names to watch. Mara is essentially shopping its entire portfolio via Starwood, and CleanSpark is doing the same thing. So I think there's a possibility that both of those names announce like portfolio deals where it's multiple sites that are offloaded for AI development. And then there's also the possibility that they aren't able to sign any leases, so I think the range of outcomes is very wide. And I don't have a ton of conviction which way it's going to play out.
Yeah.
Just to follow up on that, we've talked a lot about this transition. You mentioned the power pipelines as a key differentiator. So whether you call it luck or being in the right place at the right time, whatever the case is, these former miners have massive, massive portfolios. Can you talk to us about the advantages that these former Bitcoin miners have coming into the data center world, whether it's Colo or CSP, versus some of the existing, more traditional data center companies?
Yeah, the biggest advantage is actually a kind of a rude thing to say, which is that they're starting from such crappy places as businesses. Like the cost of capital to mine Bitcoin is so high, you're not able to debt finance your capex. Everything has to be equity funded, and then your revenues fall by 50% every 4 years. So it's a cost of capital that approaches 20%. And now we're looking at GPU financing getting done in the 6% range. So it's about exploiting that arbitrage first and foremost with existing capacity, and that is instantaneous value creation. When it comes to the pipelines, like I do think that there is a differentiator for these companies, but it's born from their desperation, which is they in their DNA, they always have to be searching for what's the next site where 1 to 2 to 3 cents per kilowatt power costs are feasible, and find that site and lock it up quickly before an industrial customer willing to pay more comes along. So that DNA of just continually finding, sourcing, developing sites until they're energized, and then finding the best use for the power. The second part, finding the best use for the power, that may end up being someone else's job, like the Core Weave who comes in and leases the space from Core Scientific. But given in America, our electricity generation has been flat for 2 decades because we globalized and we outsourced a lot of our industrial production to the rest of the world, where commodity prices and electricity prices were cheaper, and now that dynamic is reversing. The world is deglobalizing. Where there's these trade blocks that are emerging. When it comes to AI, people don't want to use the same molecules like you can for a barrel of oil because they want their data to be sovereign and not leak outside their borders. So this creates this a kind of extra building that needs to be done, because you can't serve the AI from like one enormous data center in Iceland. You have to do it regionally, and that aspect, I think, has been underappreciated by the market. Constrained supply for 2 decades, and now several forces: deglobalization, AI, the emergence of Bitcoin, all conspiring to increase the demand for electricity. So, everyone's saying it, but this time to power advantage that the miners have is turning into high return on capital for these power pipelines.
That's a great response. I like the terminology for the Bitcoin miners we're at the moment. I'll make a great short. Now, in terms of those miners moving into the HPC space, we've been inundated with transparency on these deals they've been signing. I mean, it must be music to your ears to see everything laid out there for all these companies. I'm also thinking everyone's putting out their best possible view of these deals in terms of the reality is when they start delivering service agreements, there are payment mechanisms involved in those service agreements that if they don't deliver by by contract, they'll be penalized for that. In terms of the miners who've already put out, and maybe some of the ones that are gearing up to sign contracts, who stands out for you at the moment as companies, not just maybe one, but maybe a few, that you expect to really deliver from what you've seen of their previous business, the way they go about, building sites, utilizing that power grid, building, who have they got the capacity to sort of deliver these contracts, who's actually managed to agree some of the best deals at the moment out there from those companies moving from the Bitcoin mining space.
So, we're tracking about 15 of these companies, and we do a bottoms up, site by site analysis with a probability weighting that the site is actually energized and there's a customer, and we assign different costs of capital for each site, which is related to who the parent company is and how they may finance it. And so it's hard to generalize. There's a difference between the company and then the stock, right? Sometimes like the worst companies end up having the most interesting stocks at any given point in time. So, our position sizes are kind of the combination of those factors. But of those 15 companies, 13 of them are in active discussions with AI lessors of their space. Two of them are in advanced negotiations. So that's a different terminology where it sounds to us like the lease is closer to being signed. So TeraWulf and BitDeer are definitely the two names that have been signaling, this advanced negotiations where we would probably expect some incremental deal, over the next 30 to 60 days. And as we've seen, that's been a big catalyst for the name. So depending on your time horizon, an investor may want to play for the highest probability of a deal in the next 30 days. Maybe they're in the options market or they have a shorter time horizon. A longer term investor may look at different factors. And I think one big point of differentiation between these names is, are you leasing the powered shell? Is it a real estate transaction, or are you actually running the GPUs yourself? So, Iron kind of stands out as that latter business model where the overall profit dollars may be larger, but the margins, may be lower. And then you have companies like Hut, who is signing these triple net leases, which means that the customer is going to pay for all of the costs, right? It's 100% gross margin. And when you look to finance the CapEx associated with a triple net lease, the terms are just much, much better. And those can be, those names, like a Hut or a Cipher also has a triple net lease. Those are going to be less volatile. And so an investor may be able to stomach a larger position size in a company that has a triple net lease versus, a more volatile kind of shorter contract terms like an Iron. So you can look at our portfolio and kind of see how we balance those risks and rewards. And sorry to dodge your question about, which stand out, but I think it's important to kind of put them into those categories.
Yeah, no, it's interesting. And if I go back a couple of years ago when some of the early companies started to talk about this transition, I mean, we know now Iron were thinking about this years and years ago, and you highlighted a great tweet prior to their IPO back in 2021, where you'd spoke to Dan about that move there. Now, I was speaking with 3 or 4 of your colleagues on a trip to the North Sweden a couple of years ago to go and see Hive's facilities. And having the opportunity to spend quite a few hours traveling with these guys, I talked about, how they look at Bitcoin mining versus the opportunities maybe in high performance compute. And they were giving me their sort of indication that, they didn't really see the mining as a business model, and therefore the multiples were quite low, maybe in the sort of like low single digits, 2 to 3 maybe. But HPC provided a real opportunity, even at that point in time. Where do you think, in terms of multiples, EBITDA multiples to give valuations on some of these companies, where should we be looking at for the miners now moving there? Because you go and source, anything between 15 and 45, but where would you guys be looking as a multiple on some of the deals that we've seen already?
Yeah, I mean, we still like to just DCF each site by site to get to our price targets, because if you're looking at the EBITDA multiples, you still have to look a couple of years out into
Yeah.
2028, 2029. But, roughly speaking, the Bitcoin mining portion, if it's even profitable, is kind of a
Yeah.
low to mid single digit EBITDA multiple. The higher quality names in the Bitcoin mining space from an AI HPC perspective, the Wolves and the Ciphers, the Huts, maybe are at 10 to 12 times that kind of 2028 EBITDA number, and then the incumbents like the Equinixes of the world, or the data center REITs like DLR, can be 20 times plus. So I guess that's kind of how we're thinking about it. There's still a re-rating opportunity between the miners and the data center REITs. Plus, you're going to get the much faster earnings growth on top of it.
Yeah, thank you.
I got one for you, Matt. See if you can dodge this one. You've been posting about White Fiber quite a bit. This is a company that we've covered since before Sam actually split the two sides of the business. Bit Digital more focused on Ethereum, White Fiber on the HPC AI. This is an interesting one. You talk about sovereign data. They operate in Canada. They have that North Carolina One site. They've also got tremendous growth in place here in terms of their pipeline, but Bit Digital owns over 70% of the shares. So we've seen actually 20% gains the last 2 days on White Fiber. Can you talk to us a little bit about what you're seeing here, maybe what the market's overlooking?
Yeah, we participated in the White Fiber IPO last year and thought that Sam was correct to be so aggressive in isolating that AI opportunity and spinning it off into a new public company when there was a shortage of such companies in the market. We have not owned Bit Digital, not a fan of DATs, broadly speaking. So part of my process is to structurally underweight companies with leverage. So, we haven't liked the idea of just levering up to buy Bitcoin, levering up to buy Ethereum. And I know there's a lot of folks like to highlight the discount to NAV that Bit Digital trades at once you incorporate their White Fiber stake. Like, all I see is a big tax bill, honestly, from that, because they have no way, as far as I can tell, to monetize that White Fiber stake without incurring, big taxable gains. So the discount can stay wide from my perspective until shareholders can see a path to realizing value. And I think it was smart of Bit Digital to promise not to sell any of those White Fiber shares for this year. It's such a small company, arguably, shouldn't even be public in a more normal market. And so you need to support that little guy any way you can. So I just like the pure play, and I think that he's found an interesting niche to refurbish some of these old industrial sites into, cloud computing and AI factories. Branching out into Europe was a pleasant surprise. I don't think most people were expecting that geographic diversity, and then they're tied into Cerebras, which is a chip maker that recently went public and is looking themselves to be a vertically integrated AI factory provider, but they don't have the data center expertise. So White Fiber looks cheap to us, but it's a small cap. It's going to be very volatile, and so finding the right position sizes for these types of names, I think, can save you some sleep and losses when things are more volatile.
We should give Sam a bit more credit, because I think Sam was the first CEO to come on the podcast and effectively state that Bitcoin mining just wasn't working as a business model for Bit Digital at the time there. And that was a long, long time ago. And he even came up and said, look, even if the Bitcoin price got to 135,000, this is before it reached six figures, they still have a better model using their power towards HPC. So we've got to give them some credibility for that there. In terms of their deal with Nscale, I know it's not the biggest deal on the market, but the numbers tend to stack up really well in terms of that 40 megawatt deal, delivering over $80 million per year in terms of revenues, which puts it over the 2 million per megawatt. If you're using sort of an easy comparator, so what each of the miners are going to be receiving from revenue per megawatt as an easy metric. It doesn't tell us much about the costs. Obviously, you've still got to deliver that, but it sounds like they've got some good deals there. That's not my question. My question really is about having that power. Does that, is that the bottleneck, and is that the real valuable asset now that these miners hold, or do you see power's just not enough?
I mean, from our read of how of what these stocks are discounting, they're discounting the leases for the most part, and then applying a haircut to the uncontracted power. So when you see these, huge, Iron has 10 gigawatts, it's like the market's not paying for that yet, and you probably shouldn't either until some of it starts to get de-risked in the form of timelines for energization, permits, and eventually leases. So it's nice to have. It keeps the story going, but the market's going to move on the leases and the regulatory developments.
In terms of timeframes here, we know that a lot of the hyperscalers, we'll talk about SpaceX in a second, they're bringing on dozens or hundreds of gigawatts worth of capacity in the next few years. Seems like most of that new generation, to your earlier point, not maybe till 2030 or beyond. Do you feel like this window of opportunity is shrinking for the quote unquote miners? Do you think it's a one-off kind of opportunity, or maybe a blueprint moving forward longer term, even once that generation is in place?
Did you say SpaceX?
I did, yeah. As an example of one of the companies that they've, I think, committed to 100 gigawatts a year by 2030. Do you think that's a benefit to these companies transitioning, or do you think the window of opportunity is shrinking here?
Yeah, I tweeted last week that some of these Bitcoin miners may actually end up owning SpaceX stock because from the numbers from the math that we've done, when you add up what SpaceX has already announced in terms of leases to Anthropic, Google, and then Cursor, which they are acquiring, they don't have anything else left to sell. And the story in the S1 is that they're now a compute factory. So Elon's going to have to build this or buy it, and the gating factor is the energization timelines that he can't control, because there's bottlenecks on the turbines, there's bottlenecks on the chips, and there's bottlenecks on the power. So I happen to think that SpaceX going up like this is great for these stocks, that there's a decent chance that some of them will either get leases from SpaceX or get acquired by SpaceX. And since SpaceX has $1 billion of Bitcoin on their balance sheet, it's not that they're unfamiliar with the business of Bitcoin. So we did not participate in the SpaceX IPO in Node because frankly, I thought that if it works, it maybe end up even better for some of these miners.
Yeah, good point. In terms of what you're seeing at the moment from revenues that are coming through some of these contracts, we've had a number of CEOs saying, they're not just going to sign the first deal that comes on their table, that they believe that, as power's becoming, more the bottleneck, that, people will tend to pay more. We just covered Applied Digital and looked at their last 5 deals, and the last 3 of them are effectively with hyperscalers. They haven't named the hyperscaler, but they are grade 1 companies out there. And when you do the maths and look at the deals, they're getting slightly less revenue as each deal gets signed, and it's in that sort of 1.6 million per megawatt. Now we're seeing a lot of CEOs talk about the 2 million as a sort of like a benchmark. What are you seeing out there? And I want to align this to the fact that Anthropic and Google have just signed deals with SpaceX to effectively give them, billions of dollars a month in terms of revenues. And when you start looking at that on a, say, GPU per hour rate for the type of machines they're using, and then look at, say, maybe the Iron CSP, which was signed in November last year. So, 8 months ago, things happen very, very quickly in this space. And, there's a big disparity between the revenues there. What are you seeing in terms of, is it best to wait? Are you seeing revenues going to start increasing, or do you feel it's more, the opportunity as it comes along, take the opportunity?
Yeah, the the number that we use on this topic is the enterprise value created
Yeah.
per watt of
Oh,
electricity. Okay, so like dollars per megawatt is it kind of incorporates the top line, but the enterprise value per watt, you're also incorporating the
right.
cost of financing, right? And so those two things work together. And what we've been seeing over the last year is that that equity value per watt keeps going up,
Mm.
right? Because the cost of financing is
Getting
coming
lower.
down, right? So and that's a number that I'm really looking at carefully. If it starts to roll over and go down, that might be a signal that, the cycle is maybe reaching its tail end.
Yeah.
Interesting.
Do you feel that do you feel some of the hyperscalers have got that much power they can drive prices down with when they're having these conversations with miners because they are the sort of like the power of the size of the buyer, and they'll turn around and say, look, do a deal with us, and those funding options that you want to do will come to you far cheaper. And we also noticed a couple of companies, I think TerraWolf and Cipher Digital, have actually given away stock as part of the deals, both to Google as sort of like supporting the deal on behalf of FluidStack. What's your view on that? Do you think that's going to be more and more seen as we see more deals come to market, or do you think maybe we try and look at the Hut 8 model, which for me looks a really ingenious way, and maybe the fact that some of their special advisors have been helping them achieve those really good deals that they're coming along with.
Yeah, I think it's like some of the earlier deals, like Iron's first deal, maybe they had to sign at a prove it type of rate
Yeah, yeah.
where a lot of the value is actually in the terminal value of the data center. But in terms of putting you on the map as a legitimate counterparty to a tier one hyperscaler, it sets you up for success in the future. So, that's been a big part of it.
Yeah, thank you.
Makes sense. Great context. I wanted to dig a bit deeper on SpaceX IPO. You mentioned you guys did not participate. We know there's a lockup period here, 6 months. I think it trickles out a little bit before that. A lot of people are calling for this SpaceX IPO, Anthropic, OpenAI as another kind of top signal for the market. Can you walk us through what you guys are thinking about SpaceX currently, the valuation, and maybe your thoughts on potential market top here?
Yeah, I mean, at the firm level, we've been involved in SpaceX for a while on the private side. So, we know the story. We have exposure in other strategies. For Node specifically, I don't underestimate Elon's cost of capital. Like he's got a different cost of capital than anyone on the planet, and there's not that much float in this stock. And it's obviously working here in the first few days, and I think that's great for our Bitcoin miners because he could become an acquirer of them. But as we look out 3, 6, 9 months, there's going to be a trough of disillusionment for this company as the additional stock comes to the market. And the question is like, what does Elon do when the stock price is high? There's a lot of avenues that open up to, like you said, use that stock as a down payment on a lease to acquire more compute, or use it to acquire. That would be better for the companies that are getting bought than for SpaceX. So that's been my thesis, is just no need to chase it, wait and let their capex filter through the rest of our holdings.
It hasn't waited long. I think they've just announced a $60 billion deal today for buying a company. So they're going to be starting to spend some of that money there. But I mean, it's a great IPO, and from UK point of view, I think those investors who sort of like put down 20 shares or less probably got their full allocation. I think it was up to about £2,000, so probably maybe $2,500 in US dollars. So, but that was across the board there. So maybe smaller shareholders have got an allocation of space. Now, in terms of we've talked about Bitcoin, we've talked about mining, we've talked about HBC. We know that you're not a fan of DATs. But where do you think at the moment there is, potential for, more success in one of those four areas? Where do you see that at the moment?
Well, I mean, one area where we've had some success recently is the inference of AI is moving from, it will move on the margin from the data center to the edge for consumers and enterprises who want to run open source models and perform the compute within their own environment. Companies like there's a stock in Taiwan, Global Unichip 3443, that they were the biggest designer of Bitcoin ASICs. They were the partner of choice if you needed to design a Bitcoin ASIC. And it was like 5 or 10% of their revenues, kind of over the cycle. And they've pivoted to building TPUs for Google and for Tesla. And it's just been really interesting to watch how this value chain between Bitcoin and AI is converging, not just at the electricity level, but also in the design of the chips themselves. So Global Unichip has been a great stock for us. And I think there's a lot of growth still ahead. Tesla is going to ramp with them. Another name kind of in the same theme, like Raspberry Pi. Raspberry Pi was a toy for Ethereum, enthusiasts 10 years ago. It was my kid's first computer. They make motherboards, very cheap CPUs, ARM-based CPUs, the cheapest computer you can buy. It was a hobbyist device, just like NVIDIA chips were a hobbyist device 10 years ago. Now 80% of Raspberry Pi sales go to enterprise. So businesses are buying these to perform inference at the edge, and AI is turning IoT into an actual thing. IoT, Internet of Things, it never worked because there was nothing to do at the edge. Now there's something to do. So Raspberry Pi, that's been another one. The stock's up, 2 or 3 times this year, and we were able to get conviction because we knew it earlier as a toy. I just want to keep a very wide net and find, this intersection of AI and digital assets. And it's all a token economy, right? You're manufacturing tokens, whether they're AI tokens or Bitcoin tokens. So I hope we can still uncover some of those names.
Yeah. Just as a quick on the sort of DATs, I don't spend too long on it, but obviously we've got the likes of Strategy, and it looks like Strive are moving into that sort of bracket as well. But then you've got a whole mountain of other companies that sort of came out from nowhere trying to deliver this sort of model or a model just effectively buying Bitcoin was going to be their salvation. Where do you see that market? I mean, is it those that can and those that effectively can't, deliver? And what do you think about, what are the sort of like maybe the risks, if there are any, associated with Strategy and Strive and what they're trying to deliver there by using their stocks to purchase the Bitcoin, their preferred stocks
I mean, my view on this sector comes from covering Asian conglomerates as an equity investor for quite a while. There's lots of conglomerates in Asia that are holding companies, and they trade on a multiple to NAV. And I'll tell you, it's never a premium because a lot of times they don't pay out their cash. There's no process for a minority shareholder to actually realize the underlying value because the management is often family controlled. There's related party going on. You can't eject the CEO and monetize the NAV. And I think there's unfortunately a lot of parallels in the DAT space where why do I want to pay a premium for a stack of cryptos where I'm never actually going to see the cash? And meanwhile, at this point, MicroStrategy is barely above, MNAV. So, and on an equity basis, it's below MNAV. So when they're selling MSTR stock, it's dilutive from my perspective. It's accretive to the whole enterprise value, but it's a transfer from common equity holders to preferreds. And so I don't hate the preferreds like Stretch. I think that's a probably works, but my holding period is longer than a year, and my hurdle rate is higher than 11.5%. I can do better, I hope. So if like unless you're a T-bill investor, I don't think you get a tax advantage from Stretch, and it's just a situation that I don't have a ton of conviction. And meanwhile, the M&A, there was actually a deal that was rejected today. The largest Solana DAT tried to acquire a smaller DAT. It was rejected. So we've only seen one example of this M&A actually happen with Strive Semler. My base case is that there's too many KOLs, too many CEOs, too many board members who don't want to lose their jobs, and we're probably going to be disappointed at the pace of M&A.
Yeah.
Gotcha. Hey, now I wanted to ask, this is a pretty popular one from our retail audience. You've got a lot of experience in the space. We've heard about AI bubble. We've talked about some of these potential catalysts or top catalysts. How do you guys go about exiting a position or taking profits? This is something Anthony and I are very vocal about on the channel. Obviously, we have huge aspirations for these companies. Everyone would like to hold them indefinitely, but at the end of the day, you want to take profits along the way. What's your advice in doing so?
Yeah, I think one of the reasons our strategy has, we're up 78% and Bitcoin is down 36% since we launched, and we've done that at a pretty low volatility level relative to a lot of peers. And the way that we did that was by launching the portfolio as very diversified, and we hold call it 20% of the fund or so is in kind of low volatility stocks that don't show a huge correlation to Bitcoin right now. So things like utilities, pipelines, things where I think the underlying drivers of their business are actually, pretty similar to what's driving the Bitcoin market, but the stocks are not particularly correlated. And so when we use that piece of the portfolio as kind of a barbell, so when Bitcoin or some of our AI stocks crash, these lower beta things tend to hold up pretty well, and we can rotate some of the portfolio into the higher beta stuff, and then vice versa. We've only really taken material profits at the sector level once in early November, right after the election, and after Bitcoin peaked, we took a lot of profits out of these miners. And the great thing about running an ETF is that there's some tax-friendly ways to do this. We can get into the details. Bloomberg actually had a big story on this, but we're able to, with a little bit of planning, exit positions with large embedded capital gains on a tax-free basis, and that lowers the friction a bit when you're an institution. And so if you look at our Sharpe ratio, so our returns divided by our volatility, it screens very, very well. And part of the reason is that we have not been shy about taking profits in this tax-friendly way when we see evidence of real overheating in the market. So right now it's a Bitcoin bear market. So like I said, we really only did that once at the sector level last November, and we've kind of been adding ever since. And you can look at the performance, and it's been an okay decision. But when you see funding rates for Bitcoin really spike, when you see Coinbase app downloads, as a top 5, when your friends who never talk about crypto are asking you about why is Bitcoin up, right? Like these are times when it may be wise to take a few shekels off and put them in some lower volatility names.
Yeah, that's a great point. In terms of the portfolio, and the reason I say this is we cover on a daily basis on on our normal podcast. We have a heat map that shows you the change in share price over a number of time periods. And the one that's been fascinating us at the moment is the 1 year change. When you look at sort of like four or five of those companies that you've signed deals, so you've mentioned most of them, the TerraWolves, the Irons, the Hut 8s, the Cipher Digital, their average increase is in the sort of 500 to 600% range over the last year. And then you've got Keel, who've probably gone up as much without even signing a deal in the last 12 months. So there's plenty of optimism there, and Ben's been clear to say he'll expect 3 deals signed by the end of the year. From your sort of like ETF, how does that sort of like, do you have to sort of like start rebalancing when you get significant movements like that? Because it could send, I mean, if those people who had, say, for instance, iron last year at $5 in April, and by, I think, October it had gone to $76, it starts becoming a major part of your portfolio. And we're always told like not to have a significant amount of one stock in the portfolio just in case it does start to come down. And we know from history these stocks can go down quicker than they go up. So, we've had that discussion about selling, but how do you guys manage your sort of ETF portfolio when you're seeing these sort of like really quick spikes?
Yeah, I mean, for the most part, we want to let our winners run, and that's how you can really compound. The other thing about these names, stocks become, in a way, they can become less risky the higher they go, as long as that performance is as a result of fundamentals. The business getting bigger, the business getting less volatile, the funding sources, becoming lower cost. So, pivoting from issuing equity to issuing debt. So, some of these names I was happy to buy on a big up day if there was fundamental news that was de-risking the story. But our investment thesis for this fund was that many of the crypto equity products have higher volatility than Bitcoin. They have very high position concentration, like 10% plus positions. And regular investors, especially advisors, they don't want that type of volatility. They want a smoother ride. And so if we launch something more diversified, smaller position sizes, we may have a good shot here. And that's played out. So even, we haven't taken really any material profits in names like TerraWolf and Cipher. Aside from that, November, we took profits in November, and then we started adding back once the stocks fell. Even so, those positions are 6-7% now. So they're not like 12-13%, where I would really start to get nervous. So you ask again, and hopefully ask again in 3 months.
Yeah, that's cool.
Perfect. Hey, last one for me. I'll hand it back to Anthony before we get into closing thoughts. But Matt, growing up as a kid in Calgary, Canada here, I looked up to Wall Street professionals like yourself my entire life. It's such a privilege to have you on here, being able to talk with you at conferences, being on the same panel. What advice would you give to people in this situation? They're retail investors. They want to get involved in the market. You've got a lengthy career here. What would be kind of your top advice?
It would be to relentless curiosity, and then putting your pen to paper and writing investment memos. There's plenty of kind of templates online, but being able to distill a stock pitch into a 1 or 2 minute elevator pitch, and then a 2 to 5 page memo, and then putting that memo in front of decision makers and getting feedback, tracking your progress. This is the kind of the blocking and tackling of security selection. But one of the reasons I got into crypto was I realized that the game was changing. Retail investors were getting access to equivalent information and have been able to compete with the institutions over the last 10 years. So, I'm not sure that like Wall Street has such a huge advantage anymore when it comes to picking stocks.
Oh, that's a good answer. My last question before we hand you back for final comments is around it's a subject that comes up quite a lot through the comments on our podcast, and obviously a lot of these companies, we want to make sure that the management teams are incentivized to deliver for us, but we've seen stock compensation in recent last couple of years reach heights that I never thought I'd see in the space, having been covering these miners for about 6 years now. And it sort of appears to be like a hamster wheel. Now, I'm, I'm all for making sure that the senior management teams are certainly rewarded when I'm rewarded as an investor, when the stock price goes up and we both win. But what's your view on something like on the stock compensation in general in this particular sector? We've done comparisons with some of the biggest companies in the world in terms of percentage of revenue for stock compensation across both entities, and it's just a million miles different. And I just wonder for an industry, the oldest mining company is Hive Digital. That's 8 years old. So all these other companies we talk about are significantly less than 8 years old. But some of the amounts that we're seeing are effectively eye-watering when you compare them to the amount of revenues they're bringing in.
Yeah, the corporate governance in digital assets generally has been dismal, partially because in the token world, there's this pseudonymity layer. So there's all types of related party nonsense and, dumping on the community. Bitcoin miners, have to follow SEC regs, but still the amount of executive comp and how it was structured relative to similarly sized enterprises, was grade F 5 years ago, and now it's grade C minus. I would say like there've been some considerable improvements in aligning how the restricted stock grants are paid out for some of these names. So, some companies, and we've written if you Google it, a bunch of pieces on this and can share our thoughts, company like Mara that recently changed the CEO's compensation so that there's a ARR target, annual recurring revenue. So you can tell now that that CEO is going to be pretty incentivized to sign leases with recurring revenues because he's going to get paid on it. And we like to look at how those incentives change over time because that really tells you the likely fundamental path. The other examples like CleanSpark that had some kind of strange exec compensation, monthly payout of Bitcoin and things like that. That's also begun to be cleaned out a little bit because if they're signing a big lease with a hyperscaler, the hyperscaler doesn't want to see that nonsense, right? So you want professional investors to fund billions of dollars in capex. You have to be a little bit closer to what a normal company does, not a retail funded Bitcoin miner. And so we've been pleased with the progress. There's still some stragglers. We will be sure to call those guys out. But on balance, things are getting better, and that's part of what's been leading to the multiple expansion in the space.
Yeah, I mean, you mentioned CleanSpark there. They've just recently got rid of that sort of like preference dividend that was appearing every time the Bitcoin price went up, and it was like, it's great when the price is going up and the FASB rules help their revenue position, and then it may drop the next quarter, but then it goes back up again, and it's not like showing you the overall annual effect. They're just getting a dividend every other earnings period. So. But that's out of the way, and that means it is clear. Some of these balance sheets need to be a bit cleaner. I think even the likes of we cover a small company called Soluna Holdings. I'm not sure if you've got them come across your desk, but we quite like Soluna. But one of the disadvantages for that company was it had a really poor balance sheet, and I believe they really strengthened that now by issuing some equity stock to the preference shareholders to get that off there because. When you go and have discussions, like you quite rightly say, you want to make sure you've got the cleanest position available, not just for the client, but also for the lender who's going to come in and maybe fund that deal. They want to make sure that there's nothing there going out to another person on a before basis. They want to make sure it's a level playing field. Everyone gets paid at the right time. But
Exactly.
yeah, I mean, I've highlighted. I mean, I've seen so many changes year by year. They seem to sort of like look at, once it was like, if our hash rate grows up, we'll get more stock compensation, which is like, well, hash rates, you've got to deliver great mining margins, not mind just the hash rate going up, but it was like some weird and wonderful things. And then, when the share price dropped down, they sort of changed it. Well, let's look at the share price now and compare it to the Russell 3000. Well, your share price is its lowest it's been for like 4 years. Of course, it's going to increase. Like, it's like,
Yeah, I
it's
mean,
sort of
we
baffled.
may end up with some of the same issues under the AI regime because some of these guys are getting paid just
Going
on
to get paid.
megawatts,
They're going to get paid
total
more.
megawatts. Well, what are you
Yeah.
paying for those megawatts? Oh, that's
And
not in my
And it's
KPIs.
like, do you feel like as soon as one does it, the next company go and they see, I love it because they go and pay consultancy firms to go out there and say, am I being paid enough? And the consultancy firm will go out there and look at every other company in the space and saying, actually, you're not, because company A have just decided they're worth this amount in millions. Oh, so I need to be paid more. And the consultancy firm, yes, you do. I
Well,
guess you've paid for that before.
maybe AI is gonna kill this consultancy oligopoly because I've got Glass Lewis telling me to vote against board members because they're not gender diverse. Like I'm not going to listen to that type of logic. It's possible that that this democratization of intelligence maybe it breaks some of those business models.
I
There
seem to
you
remember
go.
some of your tweets actually referring to some of the board members of companies, asking them what they were doing for that particular. I'm not going to name the company, but what they were doing for that company because you'd done enough research about that individual and said they're not really adding value in this space. So really, it sort of like makes the company start thinking. Then, have you got the right board? Because Bitcoin mining is not high performance compute. It's not.
Exactly. Yeah, and I
You
think we're going
want
to
to make
see a
sure you're
lot of
delivering
changes.
a board that can see that transformation and have knowledge and able to guide the company in the role that they're doing as a directing director. It's not rocket science, but it's like sometimes it's job for the boys really. I mean, even these directors. I used to think non-executive directors couple of, 8 days a year, don't get a lot of, not a big part of your salary, but the packages are enormous. I would do more than 8 days. I'd give them some free days, just to get one of those packages. So anyone out there watching, I'm available. Yeah.
There you
Nice.
go. Hey, I know we're at time. That wraps up an hour with the expert here, Matt. We really appreciate your time. As I said in the intro, the transparent communication, the ability to poke holes or flaws in the business model, very refreshing to those followers of you on X. We appreciate the time. I'll give you the opportunity to close out. We look forward to having you back soon.